So let us start out by looking at a few more applications of present value. These are not only going to be helping us to recap what we studied last week, but will also allow us to get acquainted with several terms related to loans and stock markets and how do they operate. Okay. So let us consider as a first application relation related to loan repayment. Now imagine that you have taken out a fixed rate property loan. So when we say the word fixed rate, what it means is that basically the interest rate at which you have to repay back the loan, that is pre-decided in advance. So this is in contrast to what is known as a flexible rate property loan, where actually the interest rate on the loan would adjust as per the different interest rates adjusting in the economy, right? So these days there is a more of a tendency to move such flexible rate interest property loans that helps to actually protect against the economy wide changes in interest rate, and we'll study that in details later on. But for now, let us focus on the simpler case, which is the fixed rate property loan. Okay, so imagine that you have taken out a loan, and you have to basically pay back this loan, and what is required is that you have to pay a specified stream of equal cash payments each month to a bank as a result of taking out this loan, right? So just to kind of like fix ideas, imagine that you have taken out a 30-year loan for some property, and the bank requires you to make equal monthly payments. Okay, so we are going to use the notion of annuities that we have studied in order to answer the following question. So what should your monthly payment be if you have taken out a 30-year loan for 5 lakh units at a quoted interest rate of 7.5% per annum? Okay, so this is the question. Before we kind of like delve into how to actually answer these questions, note that we have used the word quoted here in quotes, right? So the reason is that actually different banks often have different conventions of how to quote the interest rate. So this is always something that you should kind of keep an eye out of whenever you are going to actually take out loans, because different banks may have different ways of quoting interest rates, and for some reason it is always kind of like quoted in a way which is actually favorable to the party which is giving out loans to you, right? So this is always something to be careful of, right? So here, when the banks actually quoted the interest rate in this particular example, we are going to follow the convention that they basically just multiplied the monthly interest rate by 12, right? So when they quoted 7.5% annual rate, what they meant was that the true monthly interest rate is actually 7.5% divided by 12, which if you do the calculation comes up to 0.625%. Okay. So in this example, the banks did not actually compound when they actually quoted, right? So this is actually a common way of quoting how to kind of like set the annual kind of rate and how is it related to the actual monthly interest that you are paying. Okay. So again, like different places have different conventions. So keep that in mind, right? So this is also meant to be a pointer towards that. Okay. So this is, imagine your true monthly interest rate. Okay. And now the question is, what would your monthly payment be if you take out a 30-year loan for 5 lakh units at a monthly interest rate of 0.625%? Okay. Now, why did we say that this is something where your previous formulas related to annuity can help you out? Well, a 30-year loan in this case, where you have to make monthly equal payments, is nothing but an annuity where you are making 360 monthly payments, right? So each year has 12 months. So 12 into 30 is 360. And because each month you are paying out the same amount, that is basically an annuity, right? And what is the interest rate here? That's 0.625%, right? Now, what's the present value of the loan that you have taken out? That's the 5 lakh amount that was quoted. So now you want to determine the fixed monthly amount that you have to pay back. So let's call that amount C. And now you can just plug in the annuity formula. So the present value of these payments is 5 lakh, right? And you are paying out C each month. So C, and the interest rate is 0.625%. So C by R, remember that was the formula, 1 minus 1 by 1 plus R to the power T, right? Where T is the total number of periods you're paying back, and that is 360 here, right? So if you plug it in and you can solve for C, you will end up getting that C is approximately equal to 3,496.07. Okay. So this is basically then what it is saying is that if you have taken out such a loan and the first payment, it has to be made next month, and each of these payments are equal, then you have to make a payment which is equal to 3496.07, right? So one thing, if you notice that if you actually multiply this 3496.07 into 360, you will actually get an amount which is not equal to 5 lakh, right? So why is this amount that is different? So there are several things, right? You have this compounding, and you have also got payments that have to be made on the interest rate, right? Because you're not repaying back this 5 lakh immediately, but you are repaying it over time. So this is also factored in, right? So you might want to just, as a first approximation, compare what happens if you multiply this by 360 and compare and see how is it related to 5 lakh, right? Okay, so this is the amount that you have to repay back every month, right? So how much of this is actually a principal amount and how much of this is the interest amount that you are repaying back? Now, why is this important? Well, there are several reasons. So one is that imagine that you want to actually repay back your loan early, right? So you have taken out a loan for 360 months, but for some reason you had some more money coming in and you are in a position to repay back, right? So the question would be, how much do you actually have to repay back if you are, let's say, repaying back everything after 10 years, right? So that would be after basically 120 months instead of the 360 months. Now, typically, by the way, the banks are going to charge you probably a fee if you want to kind of like repay back early or late. But let's ignore that detail for now. So imagine that you just want to repay back after 10 years. How much do you actually have to spend at that point to kind of like take off the loan uh, from your payment, right? So that is one question, that if you want to know that, so then basically the amount that you have to repay at that time is whatever is the remaining principal, right? Because then you are not going to have to pay for the interest for the remaining 20 years, because you are at that point just paying off all the principal, right? So in order to know how much to repay, you have to know what is the amount of principal that is remaining at that point. Okay, so we need to figure out a way of calculating that, and there may be other more practical reasons. So typically, oftentimes tax authorities charge money that is going towards payment of interest and money that is going towards payment of portion of the principal separately. So you can actually have an amount which is actually taxed and the other amount that is not taxed. So again, you will kind of like want to see that which is that, right? So these are also very interesting kind of like calculations to see if somebody has taken out EMIs and so on. And typically this breakdown is often kind of like given that, how much of the principal has been repaid and how much of the payment that you have made is going off as interest payments, right? So again, something to keep in mind. Okay, so let's look at how this works in the context of this example here. So remember that in the first month, you actually had to pay amount in interest, which is equal to 0.625% into 5 lakh, right? Why is it 5 lakh? Because remember, 5 lakh is the amount for which you have taken out the loan. So at the beginning, you have like not paid back anything. So the whole amount is the principal. And so you have to pay back basically 0.625% into 5 lakh of that. So that's 3125, right? But remember that in the first month, and in fact, each of the months, you have to pay back this 3496.07, right? So if only 3125 of that is in interest, what that means is the remaining amount that you paid back, which is equal to 3496.07 minus 3125. So that's 371.07. That's the amount of principal you have repaid back in the first month. Okay, so that's how you can break up this 3496.07 into 3125, which is the amount you are paying in interest, and 371.07, which is the amount you are repaying in principal. Now, what this does is that because you have paid off the principal 371.07, so the next time that you are repaying, the amount that is remaining is actually corresponding to 5 lakh minus 371.07, which if you do the calculation is around 499,628.93. So this is the amount of principal that is kind of remaining, and you are now have to just pay interest on this principal and not the whole one, right? Okay, so what is the amount of interest that you have to pay next month on this amount of principal? Well, again, the interest rate is 0.625%, so you can calculate that. So the next time you are making the payment, how much of that is the interest payment? So that's 0.625% multiplied by the amount, which is the remaining principal, 499,628.93. So this is the amount that you are repaying back in the interest in the second month. So 3122.68, right? So notice that this amount is actually less than 3125. And this makes sense, right? Because the first time when you were paying interest, you are paying interest on the whole 5 lakh principal, right? Now, because you have repaid back amount of the principal, right? So you are paying an interest on a lower principal, and that's why the interest payment is smaller, right? But remember, you are still paying back 3496.07, right? So if the amount in interest is lower, that means that you have repaid off a higher amount of principal, right? So in the second month, you have repaid off an amount of principal equal to 373.39. Okay. So again, we can do the same calculation. So what is the principal remaining? Well, earlier this was the amount of principal that was left, 499,628.93. Now you have basically repaid back 373.39. So the amount of principal that is remaining is 499,255.54. Okay. So this basically says that suppose you somehow have an opportunity to repay back the whole of this amount at the end of the second month. So how much money would you need in order to pay off the whole of the loan? So you will just need to kind of spend this amount of money, right? So if you spend this amount of money, you can repay back the whole loan immediately at the end of the second month. Okay. Now, you can keep on doing the same calculation. So suppose again you are required to calculate, okay, in the third month, suppose you go on, then how much of that is the interest? So again, you can calculate that by doing 0.625% multiplied by 499,255.54. So that will give you the interest payment. You are still repaying 3496.07 every month. So subtract the interest payment from this amount to get the principal payment. And from there, again, kind of like, you can adjust the principal and so on, right? So this gives you a way of breaking down for every month about the amount that you're paying, how much you are paying or back interest, and how much are you paying in terms of the reducing the principal, right? So that's, I think, a very one useful way of thinking about loan payments. And this is nothing but a direct application of annuities that we have just seen, right? So that is I think, a good example. Okay, so let's apply another concept that we studied, which is perpetuities, and think about how they can be used to provide rough approximations to the values of stocks, right? So one thing to note right at the beginning is that perpetuities by their nature are always imperfect approximations, right? Why are they imperfect approximations? Because remember, when we use the perpetuity formula, we make a whole set of assumptions, right? So we assume that the interest rate is constant forever. We assume that the growth rate is constant forever if we are talking about growing perpetuities. And we assume that the payments last forever, right? Now, these are things that are really satisfied, right? Nothing lasts forever, right? And again, the assumptions of like constant interest rate remaining the same and the growth rates remaining the same forever is also very strong, right? So why are they still used? They are used because you can actually provide very quick back of the envelope estimates, right? So by the way, the back of the envelope estimates are informal term for meaning rough calculations. They come from the fact that, you have only space for doing the calculations behind the envelope, right? So that is a very limited amount of space. So how quickly can you do the calculations in the limited space, right? So that's the idea here, that you have you want to come up with a very quick and rough approximation. So what are the tools that are available? And perpetuity formula is one such thing, right? So we can apply this to thinking about stock valuation as well, right? So let's take a look at several examples to see how we can do that. So imagine that you have a mature business, right? So mature means this is a business which has been going on for quite some time and has stabilized basically, right? So there's not much volatility in this business. And the profits that are expected from this business is 1 million next year. Okay. So the company's profit is expected to grow at a rate of 2% per annum. Let's say that is almost kind of like tied to how much you can think the inflation might be kind of like progressing, or prices in that sector might be progressing. And imagine that the firm faces a cost of capital of 8%. Okay. And we are going to assume that these two things are going to be the constant throughout. Okay. So then the growing perpetuity formula would indicate that the firm should not be worth more than this amount, 1 million divided by 8% minus 2%. So where did we get this amount? So this is, remember, the formula for the growing perpetuity, right? Which is the amount which is being paid next period divided by R minus G, right? So we have put those here. and this is approximately equal to 16.7 million, right? Now, why did we say that it should not be worth more? Because this is probably an upper bound, right? Again, we have assumed that this company is going to last forever. This is going to be paying these things forever. So these are the assumptions that we made. So this should not be 16.7 million number that we came up with. That should not be thought of as an exact value, right? This is not something which where we are being precise and everything, right? So this is something where we want to just give you a quick idea of, okay, these are the strong assumptions, right, that kind of like continue. This is our rough estimate of what the company's value today should be, right? Okay, let's look at another application. So this growing perpetuity formula that we have seen is sometimes applied directly to stock markets, right? So imagine that you have a stock and the stock is going to pay dividends, okay? Let's suppose that the stock is going to pay dividends of 10 units next year, and stock's dividend is expected to grow at a rate of 5% forever. And the appropriate rate of return for discounting this stock is, let's say, 10%, okay? Then one way of thinking about stocks is that it's the present discounted value of all the dividends that it is expected to pay out, right? So we'll deal with this in more details later on about how you might want to come up with that formula, but it's kind of related to this the fundamental value that we had discussed briefly in the first week. But again, let's just go with that. Imagine that for now, without thinking more into why that is a good approximation, let's suppose that the value of the stock is given by the present discounted value of the stocks that it is paying out. Okay. So suppose that these are the assumptions that the market analysts have, that it's that the stocks are going to pay dividends of this much amount and it's expected to grow by 5%, and the rate of return for this particular company's equity is around 10%. Then one rough approximation of what the stock price today should be is 10 divided by 10% minus 5%, right? Again, where we are getting these numbers, this is nothing but the growing perpetuity formula. So the first payment is 10 units next year, and then you have got R, which is 10%, and G, which is 5%. So if you do this calculation, you end up getting 10 divided by 10% minus 5%, right? So that's the 200. Okay. So but again, this is a very rough idea, right? This is not saying that, look, given these features, the stock price has to be definitely 200, right? Because we have discussed there are so many other things that affect stock prices, right? About, that people may be doing some momentum trading and so on. This is just meant to give you a rough idea of how to come up with a rough number of what should be a reasonable value of stocks if this is what people expect, okay? So if you apply the growing perpetuity formula using this way to stocks, then this is also known as the Gordon growth model, right? And this is something, again, that is kind of like used for making rough approximations. So now whenever you see this Gordon growth model, you know that, this is nothing but the growing perpetuity formula, okay? So let's see how, again, the Gordon growth model can be used to provide some useful applications. So imagine that you have some information about the company stocks, right? You know what is dividend yield and what is the expected dividend growth rate. Then you can actually use this to flip the formula around and use it to actually estimate what is the cost of capital for this company. Okay. So let us look at an example of how we can do that. So imagine that you have a company and the company has a forward-looking dividend yield of 2.2%, right? So what does this word mean, forward-looking dividend yield? So let's break it down. So what it means is that the dividend yield actually is the analyst's consensus forecast of the next year's dividend divided by the stock price. So remember, dividend yield already made that it's dividend divided by price. So this is something that we had already discussed last week. So the word forward-looking means that this is a prediction about next year's dividend related to the price this year, right? So for this company, when we say that forward-looking dividend yield is 2.2%, what we mean is that the analysts on average expect that the dividends next year divided by the stock price today is going to be around 2.2%, right? Okay. So why did we say that this is the consensus focus? Because typically you might have like different kind of like people having different forecasts. So this is like one way of kind of like bringing together the different forecasts that they have, right? So this is somehow we have figured out, maybe by averaging or something, that this is the prediction, right? Now, what this D by P thing that is telling us here is that we can also actually go back and think about, okay, remember in this formula, this was the dividend. next year. This was the price. So if we kind of like rearrange this, this is basically saying dividend next year divided by price is equal to R minus G, right? Now, if you are here, instead of being given the values of R, G, and D and using that to calculate P, what we are doing is we already have D by P, okay? And we are using that to come up with the estimate of R minus G, okay? So when we say that the forward-looking dividend yield is 2.2%, so if you will put that here, so then that it means is that if the the approximations provided by the Gordon growth formula make sense, then what this forward-looking dividend yield would correspond to a value of R minus G is equal to 2.2% for this company. Okay. Now, what does this mean? It means that from the information about the forward-looking dividend yield, by the way, the dividend yield is something about which the forward-looking dividend yield information about this are directly available on website, right? So this is something that is directly observable. So what this means is that you can use this to come up with a rough estimate of what does the market believe about the R minus G, right? Again, why is it a rough estimate? Because you are implicitly assuming that all the approximations that you are making when you use the Gordon growth model works, right? So it basically means that the market believes that the appropriate cost of capital, which is given by R, for the company's equity. Why is it equity? Because we are talking about the stocks here, right? Exceeds its growth rate of dividend, which is G, by 2.2%, right? Okay. Now, how can we go from here to actually come up with an estimate for R? Well, we need to figure out an estimate for what's the growth rate of dividends, right? If we have an estimate for what is the growth rate of dividends that is expected, and we already have an estimate for R minus G, we can use that to calculate what should be R, right? So how do we do that? Well, one way of looking at it is like, you can see what's the trend of dividend payments in this company, right? Again, remember, this is meant to be a rough exercise. So all of these are very rough estimates. And imagine that somebody saw that the company paid out in dividends 6.6 billion last year. Okay. And this is roughly speaking the same amount that it has been paying out over the last few years. Okay. So from there, one can come up that with an estimate that, okay, it doesn't seem that the company's dividends seem to be growing, and perhaps 0% per year is a good estimate of the future growth rate of the company's dividends, right? Again, very rough approximations based on the last few years data. Okay. So then here, if we have already got R minus G is equal to 2.2%, and we come up with the estimate of G, which is 0%, that allows us to actually come up with a actually an estimate of this R, right, which is the per annum cost of capital of about 2.2%, right? So again, these are kind of like very quick approximations, but the idea is that given whatever is observed, so here what we use the data on forward looking dividend yield, which is again an information that is available if you go into these finance websites for different companies, and we used basically information about the dividends that have been happening, and implicitly assuming that this trend is going to continue to happen in the future as well, to come up with a rough estimate of what the implied per annum cost of capital is, right? So again, this is, just to be clear, just an approximation, right? We are not saying that this definitely says this, because remember, we made so many assumptions, but the idea is that at least we have a very quick estimate of what this amount is, right? Of course, some of the assumptions that we made, I have already stated, but again, implicitly, because you use the Gordon growth model, you're also assuming that the growth rate of dividends and the cost of capital are going to remain the same constant forever, which again is not necessarily a good assumption, but is useful in starting out as a place to begin our conversation with.